Today, in this episode, we are going to cover the remaining topics from our previous video on everything about order blocks. If you haven't watched the earlier part of this concept, make sure to check it out. In this video, we will explain the 4 types of entries using order blocks, along with the rules and criteria for identifying high-quality order blocks. Let's dive in, but before we continue, if you find something interesting, please give this video a like. And if you're new here, don't forget to subscribe to our channel and turn on notifications so you never miss our latest uploads. We'll see you right after the intro and disclaimer. There are 4 primary types of entries that can be utilized when executing trades using order blocks. The selection of a specific entry type depends on several market factors such as market movement, sessions, volatility, and other relevant conditions. By considering these elements, we can determine the most suitable entry type for executing trades effectively. The first entry method involves using the wick to execute trades. In this type of entry, after identifying a valid order block, we place a buy or sell order directly on the wick. In the case of a sell position, we set the stop loss at a spread size above the higher wick of the order block. This entry setup provides a wider stop loss margin, which can directly affect the reward to risk ratio by lowering it. However, using this type of entry increases the probability of your order being triggered, since price may simply touch the wick before moving in your expected direction. The second entry type is known as the body entry. In this method, once a valid order block is identified, the entry is placed based on the body of the candle. For sell positions, the stop loss is set at a spread size above the higher wick of the order block. This entry type typically provides a higher reward to risk ratio compared to the previous method, because the stop loss is tighter. However, this approach carries a slightly greater level of risk, as there is a chance that price may only touch the wick of the order block and then move in the anticipated direction without triggering your buy or sell order. Let's move to the next entry type. The third type of entry involves placing the order at the midpoint of the order block's zone once a valid order block is identified. In the case of a bearish scenario, the stop loss is set at a spread size above the highest point of the order block. This entry method provides a reward to risk ratio that is at least twice as large as the regular entry types discussed earlier. This advantage comes from the refined entry level and the smaller size of the stop loss. The fourth entry type is based on placing the entry using the body of the candle. Once a valid order block is identified, in sell positions, the stop loss is positioned to touch the higher wick of the order block. This entry method is undoubtedly riskier, as the stop loss is located within the order block zone. If the market intends to fully reverse the order block, it may trigger the stop loss. It is important to recognize the increased risk associated with this entry approach. There are 4 crucial rules we need to follow in order to recognize order blocks with a strong probability of success. Rule number 1 explains that a high-quality order block should create a notable inefficiency. Inefficiency refers to the imbalance between buyers and sellers in the market, producing a disequilibrium that eventually needs to be addressed. This is typically seen as a gap within the candles. To illustrate, let's look at 2 situations. If a 3-candle sequence shows no gaps, it is classified as efficiency. In contrast, if a gap exists within the candles, it represents inefficiency. Rule number 2 highlights that a high-quality order block must trigger either a break of structure or a change of character in the market. A break of structure or change of character are key confirmations that signal whether the market will keep moving in the same direction or shift into a reversal. Rule number 3 states that price must sweep a liquidity zone before tapping into the order block, by requiring price to clear a liquidity zone prior to reaching the order block. Traders can strengthen the reliability and accuracy of the order block as a potential reversal area or zone of interest. This rule ensures there is proper market participation and validation of the order block's importance before considering it for trading decisions. Liquidity represents an area on the chart where a large pool of money rests, such as stop losses or pending buy and sell orders. When a trader is stopped out of a position, the market absorbs the funds tied to that stop loss. The market constantly seeks to capture this liquidity to fuel momentum. In essence, liquidity is the lifeblood of the market, playing a critical role in its structure and dynamics. It is often believed that central banks or large financial institutions may influence price action. creating situations that mislead traders into thinking they understand the direction. It is essential to recognize that if price sweeps liquidity before reaching our identified order block, then that order block can be viewed as a zone with a higher probability of success. The theory is that market movement depends on liquidity. If price does not sweep liquidity before testing an order block, there is a higher likelihood that zone will be used as a liquidity source to drive momentum. This factor must be considered when spotting potential entry points, as it can greatly impact trading outcomes. In this example, we can observe two bullish breaks of structure to the upside, forming two distinct bullish order blocks. After a minor reaction from the first order block, price dropped to sweep the liquidity resting below it, including equal lows. The reason price failed to reverse from the upper order block was the lack of a liquidity sweep prior to reaching it. As a result, that order block served as liquidity to fuel momentum. In contrast, the reversal from the extreme order block occurred because liquidity was taken below the upper block and equal lows. By sweeping liquidity, price accumulated momentum and gained the energy to rally. Once it reached the extreme order block, price immediately reversed and made a strong upward move to clear buy-side liquidity. Therefore, the extreme order block delivered a higher probability of success as a trading setup. Rule number 4 states that the order block must remain unmitigated. Order blocks are generally viewed as one-time use, meaning we look for the trading opportunity when price first interacts with the order block. Once an order block has been mitigated, it is no longer regarded as a valid area of interest for future trades. Mitigation occurs when price pushes beyond the boundaries of the order block and the inefficiency has been balanced, causing it to lose relevance as a trading zone. Any subsequent retest of that order block is unlikely to offer the same quality of opportunities as the initial entry. That's it, traders. In these 2 episodes, we have thoroughly discussed the critical aspects of order blocks, including how to correctly identify them on the chart and determine high-quality ones. We also examined various entry models that can be applied with order blocks. In the upcoming episodes, we will move into advanced trading strategies. Stay tuned for more in-depth insights, and thank you for watching this video. I hope you found this video informative and valuable. Don't forget to hit the like button, and if you're new here, make sure to subscribe and turn on notifications to stay updated with all our latest content. We genuinely appreciate your feedback and suggestions. So drop your comments below and let us know the topics you'd like us to cover in future videos. Your support means everything, and we look forward to seeing you in the next episode.